Okay, we're picking up in our video series here. And last time I talked about what your FERS pension consisted of. This time I'm going to tell you how you can calculate your pension, as well as talk a little bit about that FERS supplement for those of you that retire under age 62. Most of you know that your pension is based on something called your high three. Those are your highest 36 consecutive months of pay. They aren't necessarily your last 3 years. For example, if you worked for a period of time with a locality adjustment that's very high, like Houston or San Francisco, and then spent the last couple of years of your working career, say in San Antonio or someplace else in the Midwest, those Houston and San Francisco localities could very well have a higher high three than your last 3 years of service. So always keep that in mind. If you're working with somebody that's calculating your pension, make sure that you clarify that you know what your high three is. Okay? Your high three is going to include your locality pay, your basic pay, your hazardous duty and environmental pay, and some administratively uncontrolled overtime. But I want you to understand that bonuses, regular overtime, and for those of you that are air traffic controllers, your premium pay is not factored into your high three. So if you get an estimate from OPM and that high three comes back lower, more than likely that's what's going on. What will you need to calculate your pension? Well, you'll obviously need your high three, your years and months of creditable service at separation. Remember that your sick leave, any unused sick leave, is going to count as credited service time at 100%. If you're wondering, approximately 2,080 hours equals 1 year of credited service time. But even if you don't have that much, it's still going to count toward your service time when they calculate it. Any unused annual leave will either come to you as a lump sum check with your final paycheck or 10 to 14 days afterward, depending on your agency. Now, your calculation percentage that's going to be used for your annuity. If you have MRA and 30, age 60 and 20, or 62 and 5, or some variation of that, they're going to calculate your annuity at 1% of your credited service time per year. If you happen to go over age 62 and have at least 20 years of credited service or more, that factor is going to increase to 1.1. Doesn't sound like much when you hear it, but here's the reality. You're giving yourself a 10% raise permanently on your pension for the rest of your life if you work beyond age 62 with at least 20 years of credited service. This is what the calculation looks like. As you can see, we've got 30 years of credited service. High three pay is $75,000. Because you're retiring at MRA and 30, you're at that 1% calculation. That total annuity is your annual pension that's then going to be broken down per month. Now remember, they're still going to take federal income taxes and FEHB and potentially life insurance out of that as a deduction. If you've got questions, remember to reach out to us. This is what we do all day, every day. We can help you figure this out. Here's another way of looking at it. That 30% for you people that aren't math nerds actually translates into 0.30. If it were 28 years of service, it would be 0.28. Okay. Now, for those of you that have crossed that age 62 threshold and you've got more than 20 years of service, same situation. Let's say that the high three is still 75,000. We're looking at 32 years of service instead of 30, but with that 1.1, instead of a monthly check gross of $1,875, this person is going to get $2,200 per month. As you can understand, that comes, and that's the gross. They're still going to take out the survivor benefit if you're married and your spouse is going to need that health insurance if you pass away before they do. I'll talk about that in the health insurance segment coming up in one of these later weeks here. Also, federal and state income taxes and health and life insurance deductions will come out of that before you get that net check. This is another way of spelling it out, again, with the percentage or a decimal. Now, FERS Special Supplement. For those of you that are retiring before age 62, which is the earliest age you can draw Social Security, but say you've got that MRA in 30 or that age 60 in 20, your FERS pension gives you a special supplement that's calculated as a fraction of the number of years of service that you have. This one, we're saying somebody has 30 credited years of service, and we're going to divide, the denominator is always going to be 40. So if you've got 28 years of service, it's 28 divided by 40. If you've got 35 years of service, it's 35 divided by 40. That's going to give you that decimal amount. They're going to look at what your age 62 Social Security benefit is projected to be, and you're going to get that fraction of your age 62 Social Security benefit as a FERS supplement. This supplement is automatically going to stop the month that you turn age 62, whether or not you elect to start taking Social Security. So be aware of that. And of course, the last thing that I'm going to cover today is that cost of living increase. Like Social Security, your FERS pension or your CSRS pension are going to be given a cost of living adjustment every year. It is tied to the Consumer Price Index. Many of you may not have even been aware of or paid attention to the Consumer Price Index until about a year and a half, 2 years ago, when inflation really started taking off. That CPI number is what we're using to determine what inflation is. And they're going to look at it on an annualized basis. If inflation or the CPI is coming in up to 2%, they're going to give you that full amount as your cost of living adjustment. So if CPI is coming in at 1.75%, that's going to be your COLA. If the CPI is somewhere between 2% and 3%, they're going to give you a 2% COLA. If, however, like last year, that CPI is higher than 3%, the cost of living increase that you're going to get is going to be CPI minus 1. In 2022, CPI ended out the year at 8.7%. Therefore, if you were getting a federal FERS pension, you got a 7.7% cost of living increase going into 2023. If you've got questions about how your pension is calculated or any of your other federal benefits, I encourage you to click the link below and fill out our evaluation form if you haven't already done so. It's going to be completely confidential, and we're not going to share your information with anybody else. When you submit that evaluation form, we're going to send you 2 gifts. The first one is going to be a copy of a book that we've designed called When I Die, Look Here First. It's a book that we've compiled that will allow you to document important things like your password, any funeral plans that you may or may not have made, important contact information like your doctors and other professionals that you utilize, and who you want to take care of your pets, what, if any, funeral arrangements that you've made. The back half of the book gives you an opportunity to share a little bit about your life story so that future generations can see it in your own handwriting and hear it in your own voice. It's going to be our complimentary gift to you for filling out the evaluation form. And then we're also going to include a code for you to watch the movie called The Baby Boomer Dilemma. Now, I could go on and on about this movie, but instead I'm going to show you a 2-minute trailer after I finish talking that will explain it far better than I could. We look forward to helping you understand how all of your federal benefits will work and helping you create a successful retirement.
Counting on a pension being there when you retire, you should be aware that there are consultant corporations are busy hiring to figure out how to screw you out of your pension benefit. And that's what's happening across the world right now.
and it's scandalous, and it's creepy.
Everybody seems to like a pension. If you doubt that, try taking it away from them and you'll see how people react.
Those are a risky type of retirement plan to operate because you don't have a lot of certainty today about what your obligations will be in the future.
Well, most people refer to me as the father of 401k because I got internal revenue approval of the first 401k savings plan.
I don't want to do what my father's family did. I don't want to do that.
I know lots of people who have a 401k and it works really well.
When the dot-com bubble burst, my 401k became a 201k. I did not know that you could lose money in a 401k.
I'm ready to retire. We have all of our money, and then the crash happens.
The reality is that you chose the risk-based option where money was in the market.
You give the burden of planning retirement, place it upon the shoulders of the person who knows the least. I think it was a disaster.
There's got to be a better way to try to save for retirement than using something where half your money can disappear almost overnight and there's nothing you can do about it.
And what's been happening over the last few years is, yes, our accounts have been growing. It looks like we're getting wealthier, but the income that we can get from that sum of money is shrinking.
Retirement is so much different, and the advisors need to shift to become income experts and retirement income experts and risk managers.
You have to figure out what are you going to get from Social Security and Medicare.
It's been estimated that Social Security will run out of money, not entirely, but it will run out of money such that benefits will have to be cut by 1/3 for everyone, current retirees, future retirees.
What is often underappreciated is that doing nothing and really politicizing the issue is a way of doing nothing will result in a massive cut to everybody's Social Security benefits.